and we'll be your facilitators for today. We are broadcasting via webcast. If you have questions, please wait for a mic runner so that everybody can hear your question. The mailbox will also be monitored by Stephanie and Susan, so if you have questions, you're watching via the webcast, you can email the web box at calpers_ciac@calpers.ca.gov. If we don't get to your questions, please email that box and we will respond when we get back to the office. We have a very full agenda today, so let's get started. First up, we're going to have Andrea with the legislative update.
There we go. So I'm going to discuss, again, my name is Andrea Peters, and I'm with the CalPERS Legislative Affairs Division, and I'm going to give you guys a legislative update today. We are going to cover 3 bills. So let me go ahead and give you those bill numbers now so you guys already have it written down when I start discussing them. The first bill is going to be Assembly Bill 672. This is a CalPERS-sponsored bill that we spoke about last time that we were together. The second bill is going to be SB 782. Again, this is another CalPERS-sponsored bill regarding our omnibus bill. And then the last bill that we will discuss is Senate Bill 266. And this, I understand there were some questions about it, so I'm going to try and break down the bill for everyone today. So for the first bill, Assembly Bill 672, this is by Assemblymember Cervantes. Again, this is a CalPERS-sponsored bill. We've spoken about it before. This time we're able to provide you with the bill number and then also a high-level overview of what the bill does. So this bill clarifies that a disability retiree cannot return to work as a retired annuitant in the same or similar position in which the retiree disability retired from. So this is just a clarifying amendment that we're making to existing law just to make that abundantly clear that if you took a disability retirement from a position, you cannot return to it as a retired annuitant. This bill is actually being heard right now in the Assembly Appropriations Committee. The second bill that I have for you today is going to be Senate Bill 782. This is a CalPERS omnibus bill. This bill makes several technical and minor changes to the Public Employees Retirement Law. There are 2 provisions within the bill that we think that you guys might be interested in. Again, they're both clarifying. The first one clarifies that retired members who elect to receive an unmodified allowance or an option that provides for the only provides for the return of remaining contributions upon the member's death. So this is an optional settlement 1, may name a new beneficiary and provide an optional settlement for that beneficiary when the qualifying event happens after retirement. So this is more of a language consistency thing. Other laws that we have in the books currently make that abundantly clear that it has to happen after retirement. We're just making that consistent, so bringing the language up to date. The second one has to do with the conversion of unused sick leave upon retirement. So I understand that there was an audit finding that was brought to your attention, and that unused sick leave, we were having some issues moving it from one county office of education to another. So the omnibus bill is going to go ahead and make that correction for us, so that it will now allow what we already do, which is that if a member has unused sick leave with one county office of education, that sick leave can be moved over to the other county office of education, which is what is allowed under education code. But that CalPERS will convert all of that unused sick leave at the same time. So this bill, again, it's a CalPERS-sponsored bill, and it will be heard in the Appropriations Committee on Monday. So the next bill that we have is Senate Bill 266. So this is regarding disallowed compensation. There are many moving pieces to this bill, and CalPERS is still in the process of analyzing this bill. So what I'm going to do is give you guys a high-level overview of what we think the bill does. And there's some things that we're still analyzing, so this may be subject to change, and if it does, I'll make sure to provide it in the next update. So this bill will stipulate what would happen if disallowed compensation is reported. So the bill doesn't specifically tell us what disallowed compensation is. So from our understanding of the reading of the bill, disallowed compensation is a reporting of employer and employee contributions that are not allowed under existing law. We believe that this bill specifically relates to compensation earnable and pensionable compensation and whether or not it's compliant with existing law. So that's what we believe disallowed compensation to be. So, among other things, this bill would require the employer to discontinue reporting disallowed compensation. So this, for you guys, it would require you guys to back out that compensation and re-report the compensation excluding what has been determined to be disallowed. For active members, the employers would be credited the disallowed compensation, any contributions made on that disallowed compensation. And the employer would be required to return any contributions that were made by the member back to the member. So for retired members, and when I say retired members, this will also include survivors and beneficiaries. Again, the employers will be credited back the contributions made on the disallowed compensation, and CalPERS would permanently adjust that retiree's benefit to exclude the disallowed compensation. For the retired members, the survivors, and beneficiaries, so if there are certain conditions that are stipulated in the bill, if those conditions are met, the employer would need to pay back any overpayment that was paid to the member utilizing that disallowed compensation back to CalPERS. So existing law has the member paying back CalPERS. This law would change that so that the employer would be responsible for paying that overpayment back to CalPERS. It also requires the employer to reach a settlement or an agreement with the retired member, the beneficiary, or the survivor based on the present value actuarial equivalent that would be owed to that retired member. So this information would be provided by CalPERS to determine what that is. We believe, based on what how the bill reads, that this would be the difference between what is being paid using the disallowed compensation to the member, so monthly, what they're being paid, and then the adjusted amount that would exclude the disallowed compensation. And the difference between the two, we would find the actuarial equivalent at the present value and provide that over to the employer. And the employer would be required to reach a settlement or an agreement with the member regarding that. It also requires employers to submit compensation proposals to CalPERS, and for CalPERS to review these compensation proposals for compliance with existing law, and we have 60 days to do that. If CalPERS reviews and determines that the compensation proposal provided is in compliance with existing law, it holds CalPERS liable for the overpayment and for the settlement and/or agreement that is owed to the member. It allows CalPERS to publish items that we find to be allowable compensation. And then it also states that it does not alter the responsibility of the employer meeting with the employee organization regarding the disallowed compensation. So this bill is sponsored by the California Professional Firefighters, and it is currently on the suspense file in the Senate Appropriations Committee. And we believe that it will be tentatively heard around May 16th or 17th. So again, CalPERS is still analyzing the bill. There's a lot of moving pieces, and we're still trying to determine how we would implement this bill, if we can implement this bill. And we really can't speak to what the impact would be to your direct organization. I would recommend that if you have a question on how this would impact you, that you email the CalPERS SEAC box so we can look at that specifically for you. But we have not reached that part in the analysis yet. We're still trying to determine exactly what the bill does and how it's going to impact CalPERS. So that is my legislative update. Do we have any questions?
Good morning, Anna from Riverside County. First, regarding the Senate Bill 782, regarding the sick leave.
Yes.
You mentioned that CalPERS will convert all sick leave at the same time? What does that mean?
Unused sick leave. So what was happening was that a county office of education was reporting it, and because it was within a different county office of education, I believe the audit finding was saying that we couldn't combine the two. And so what we're doing now is this law is clarifying, and we have been in the past. We'd been allowing whatever the last report employer was reporting, that was what we were converting. And they were saying that it had to be separated out by the County Office of Education. This law would clarify that whatever we receive upon retirement, that is what we are going to convert, based on what's allowed under Education Code.
Okay. And regarding Senate Bill 266, you said it will be heard on May 17th or 16th?
May 16th or 17th, it's in Senate Appropriations, and they have not scheduled the hearing for the suspense file.
So I'm sorry, I don't understand what's the purpose of that, or what is?
So the Appropriations Committee determines how much the bill is going to cost and whether or not the legislature wants to spend the money this year. So the legislature only has a certain amount of money to spend each year. And so anything that goes over a certain threshold ends up on a suspense calendar. And so all of these bills will be looked at the same time, and they will determine and prioritize where they want to spend their money. So there is an appropriation for SB 266, there is a cost. And so they've got to look at what they believe that cost is and determine whether or not they want to move it forward so it goes to the second house, or whether or not it's going to remain in the first house and inevitably dies.
Okay, thank you.
No problem. Any other questions?
This is Veena from Orange County.
Hello.
I have 3 questions. They all know I have always too many questions. You will get used to it too. I'm just kidding. My first one is, I didn't get a chance to read the whole thing, but I just wanted to make sure I verify the disability retiree. It's for the 960-hour position that they take as a retiree, 960 hour.
So it's a retired annuitant position.
Right.
This isn't specific to the 960-hour requirement. This is saying that if you took a disability retirement from your existing position because you couldn't do the duties that were in that position, your employer cannot hire you back into that same position.
Even as a retiree.
Correct.
Which is 960 hour limitation.
Correct.
Okay. Second one on the sick leave.
Mm-hmm.
And you know how in school system we can transfer sick leave from, just like you said, but sometime when the sick leave is transferred from a certificated job to a classified job, and then when the employee leaves, whatever the balance of the sick leave is as of that time, we just transfer that to another entity. And do we have to provide any kind of a clarification on that, or that doesn't matter?
So
it's
that,
whatever is on the books as of that time.
So if we're talking about a person moving from classified to certificated, then that would be a CalPERS question. If it's certificated to classified, if the from the way that we've written the law, if the education code allows it, we will also allow it.
You will honor it. Thank
Correct.
you. And
Okay, we're going to have to go to our next presenter. If you have additional questions, we can email the mailbox.
Sounds great.
Thank you very much. Do we have Chris Wall here? Chris. So we're going to go back on the agenda. All right, Chris. Welcome. There you go.
Okay. All right. My name is Chris Wall, and I'm a manager in CalPERS Office of Audit Services. And last year, we completed a review on pay rate increases. And so I'm going to kind of just go over some of the most common audit findings that we did that came up during that review. The first thing I want to do is kind of go over the agenda, what I'll be looking at. We're going to go over the objective of the review. We'll cover a breakdown of the agencies that we looked at, and then the most common findings. We looked at pay schedules, full-time pay rates for classified employees, full-time service credit for certificated employees. We looked at pay rates being reported as earned, and we have findings related to retroactive salary adjustments. First, the objective of the review. The objective was to determine whether increases to members' pay rates were granted and reported to CalPERS in compliance with Public Employees Retirement Law, the PERL, and the CalPERS Public Employees Pension Reform Act of 2013, which is PEPRA. And when we looked at them, we looked at a total of, I believe it was 64 agencies during this cycle. 42 of them were public agencies, 12 of them were the schools from this room, and 10 of them were state agencies. When I go through the most common audit findings, I'm only going to focus on findings related to schools. So anything that's specific to public agencies or state agencies, I won't be discussing that. So everything here will be relevant to you guys. The first one that we came across, and this is pretty much, and this one's kind of common across all agencies, not just the schools. It's really anything we audited, they have pay schedule findings. But the most common issues were either they did not include the time base, whether the time base was hourly, monthly, daily. It doesn't specify what the time base was. It did not include the correct full-time pay rate. This will kind of be tied in with the certificated finding that I'll go over, or the classified finding that I'll go over here in a minute. It wasn't properly approved. It did not have any effective dates, did not have the dates of revision, and it didn't always include all the position titles. Those are the most common issues related to pay schedules. The next one is going to have to do with pay rates. And first, I kind of want to go over the definition of the pay rate for schools. And the definition is Government Code 20636.1 states, pay rate means the normal monthly rate of pay or base pay of the member paid in cash to similarly situated members of the same group or class of employment for services rendered on a full-time basis during normal working hours. And what's really important for this particular section is it does specify that for purposes of this part, for classified members, the full-time employment is 40 hours per week. And that's going to go directly into what the next issue is related to pay rate, or related to schools. And that's classified employees. When we looked at the pay rates being reported, we found that a lot of times it's a monthly pay rate that was being reported to CalPERS. But when we looked into everything and talked to the people at the agency, we found that the monthly amounts actually more like it's the earnings that are being reported. And it's derived from taking the hourly pay rate, which for the most part we usually found to be the correct pay rate for the employees. They multiplied the hourly pay rate times the number of contracted days, times the number of hours per day, and then divided it by the number of months worked, and came up with a monthly pay rate. But really that's the earnings. And the pay rate, because it's got to be based on 40 hours for a full year, which would be 52 weeks, the pay rate needs to be reported based on 2,080 hours, whether it's hourly, daily, or monthly. It needs to be the pay rate for working full-time for the position. And since the government code specifies 40 hours per week, it has to be based on the 2,080. So that's the first finding. That's probably the most common one when we looked at schools that came up. This next one has to do with certificated employees. And with certificated employees, let me go ahead and read the government code to you. The government code section 20962 specifies school employees who are certificated members under the terms and conditions prescribed by the board shall earn 1 academic year of service for persons employed on an academic year. And when we did the audit, a couple of agencies, what we found is they reported the monthly pay rate, and schools are kind of different, or certificated is different than the classified because they don't have that 40-hour requirement, but they do have to get a full-time service credit. And really, in order to give them the full-time service credit, we usually see that it's reported monthly unless they're truly a full-time employee working 2,080 hours in a year. In order to get the full-time service credit, they report the monthly pay rate to match the earnings. And what we found is, in a couple of examples, they reported the monthly pay rate for most of the months out, most of their career, but then they switched them from a monthly pay rate to an hourly pay rate. But when they did it, the hourly pay rate that was being reported to us was taking the monthly pay rate, and just the exact opposite of what I discussed for the classified, divided by the number of contracted days, divided by the number of hours per day, and they came up with an hourly pay rate. Well, when you reported it to us, because everything we do calculates it based on 2,080 hours if you report hourly, these employees didn't receive a full-time service credit. And when we looked at their calculations for the retirement, we could see that for those particular years, they didn't receive it. So it's important for those employees to make sure that they report a pay rate that gives them the full-time the full-time service credit for the academic year. And it also kind of impacted their pay rates that were reported and used in their calculations too. But the most important thing is that they didn't get the full-time service credit. This next part is I'm going to kind of go into, and I'm kind of going fast because we do have 15 minutes and there's quite a bit to go over. This has to do with being reported as earned, and this is really has to do with that employees at most of your agencies work either 10 or 11 months. And what we found when we did the audit is it doesn't mean that they actually worked exactly 10 or 11 months. It means they worked an average number, the number of days they worked were the average for 10 or 11 months. And Government Code Section 20630 states, when compensation is reported to the board, the employer shall identify the pay period in which the compensation was earned, regardless of when it was reported or paid. And the most common issue that we ran into is your agencies, like I was saying, work 10 or 11 months employees, an average number of days. But when we looked at your academic calendar and talked to the staff at the agencies, we found during the review that 10 months employees frequently worked a few days in over 11 months. And the 11-month employees usually worked over 12 months because they work a couple of days in one of those summer months. But because they do work a couple of days, the pay rate needs to be reported in those months. So pay rate and earnings need to be reported in all months when they actually worked. So if you guys consider that they're a 10-month employee, but when you look at their academic calendar, they're actually working in 11 months, the pay rate and earnings need to be reported in those 11 months. And then the next issue that we ran into had to do with retroactive adjustments. And this is really a common one, and no matter what type of agency we looked at, whether it was schools, state, public agency, we found that a good portion of the time that people report retroactive adjustments, they do it incorrectly. So this one's not specific to schools, but it did happen a lot in schools as well, because you do report a lot of retroactive adjustments the way you guys report. And the Public Agency and Schools Reference Guide says a retroactive salary adjustment is to capture salary increases covering a single or multiple earned periods. And when we looked at it, there were several ways it was wrong that was most common. First, they would use the wrong pay rate. Sometimes they'd use the old pay rate, sometimes they'd use the new pay rate, and other times they'd use the average of the two pay rates. But whatever way it is, it needs to be the correct pay rate that's being reported for the adjustment. And then they also use the wrong earned period. They would report the entire adjustment reported, it would all be adjusted in one pay period. So for instance, if the pay adjustment was covering 2 months, they would report it all in one single biweekly pay period, or in schools, I think it's a monthly pay period. But they would all be done in one, so it was kind of not calculating out correctly for us. Or the entire adjustment would be added to the reported earnings in the current earned period. So if you're reporting payroll for, let's say, January of 2018, you would just take whatever the retro salary adjustment is, add it to the earned period in that month, and just report the entire all the earnings to us at once. And so those are the most common ways we found that the retro adjustments were wrong when that were actually for a retro salary adjustment. The next slide, I'm going to go a little bit more into the retroactive special compensation adjustment, because those were incorrect as well. And those are retroactive special compensation adjustments are used to report or correct special compensation covering a single amount or multiple earned periods. And they're kind of wrong for pretty much the same reasons, but most common issues for retroactive special compensation adjustments are it's the same thing, wrong pay rate used for the adjustment, whether it's the old pay rate, the new pay rate, or the average pay rate. The adjustment was not reported as a separate transaction. It was just combined with it was either all reported as one line item, or in the next one it shows it was not reported for the correct earned period. And then it was added, or it could have been added to another earned period. So these are the way it's wrong. There is some good news when it comes to retroactive special compensation adjustments, which is why I really separated the two when I put them up here, because they're wrong for similar reasons. But circular letter number 200-021-17, I would recommend you guys become familiar with that. And that is a new CalPERS functionality that was effective June 17th, 2017. And that will remove the requirement to report the pay rate type and pay rate when reporting the retroactive special compensation adjustments. So I really it gives you instructions on how to report it if you're redoing a retroactive special compensation adjustment. And it really should cut out a lot of the findings that we found that related to pay rates when we looked at them. And it really becomes a problem because even if there's some error made to the pay rates for a retroactive special compensation adjustment, it could affect the final compensation amount because that could be the pay rate that's used in the calculations. But you do need to make sure that retroactive special compensation adjustments are reported in the correct earned period. So it takes away the requirement to use the pay rate, but you still do need to make sure that it's using the correct earned period. And because there's so many issues with retroactive salary adjustments it's really common amongst all agencies, all types of agencies. I put a bunch of resources up here that show you exactly how to report retroactive special compensations. There's computer-based trainings, there's student guides. I put the circular letter. If you guys look at this PowerPoint from your office, you could actually just click on the hyperlink and it'll take you to that student guide. And I think that's just about it for ours. I tried to go fast. We had some time for questions. All right, sounds good. Score. All right, thank you.
Thank you, Chris. Okay, next we have Kurt.
Thank you. All right, good morning. My name is Kurt Schneider. I work for the actuarial office at CalPERS. So every year, oh, I see. So every year we do a actuarial valuation to measure the changes that happen and adjust the contribution rate. So our funding policy works a little different than CalSTRS. We adjust the contribution, the employer contribution every single year depending on the valuation results. We completed that valuation, presented that to the board in April. They adopted new contribution rates for the employer for next fiscal year. So like I said, we measure what happened since the prior year, and what happened, what's reflected in this valuation was the return from the prior year. So this valuation is the June 30, 2018 valuation. So we're taking into account the investment return from the 2017-2018 fiscal year. There was a change in assumptions that the board adopted, which included lowering the discount rate, but also there was new mortality assumptions, a number of assumptions. And those are reflected in this valuation. So what happened, the results are, so the costs are broken out into a normal cost. That's the cost of the service that's being earned this year for the current CalPERS members, active. And then there's a contribution to pay the unfunded liability. That's the one that varies more from year to year. And so we show it here broken out in the two pieces. The new rate, normal cost rate went up a little, 0.2% up to 8.99%, and the unfunded contribution rate is 11.74%, so the total is 20.733%. That's for next fiscal year, 2019-20. And last year, in August, when we completed our valuation, we had projected that the contribution rate would be 20.7%. So this contribution rate shouldn't be any surprise, but now it's official, and that will be the rate for the next fiscal year. Here we show historically what the funded ratio was over the last 5 years, and this graph kind of tells a story and shows the funded ratio has declined. That's primarily from investment returns being less than expected and from changes in assumptions, and that new funded ratio is what's driving the increases in the contribution rate towards the unfunded liability, right? The unfunded liability is growing. One important thing for your employees is, as part of this valuation, we also calculate contributions for the PEPR members. So first I'll point out, since we're always asked, when we look at the PEPR population, the payroll for those PEPR members is $4.15 billion, which is 31% of the active payroll. So on average, 31% of your costs, retirement costs, are for PEPR members. And that benefit was designed to have a lower cost than the classic members, right? So because those members are coming in, the savings right now the contribution rate you see, the 20.773 is about 0.8% lower than it would have been if all your members were in Classic. So that is the current savings. And the other thing that we have to do is calculate the contribution rate for the PEPR members. Their member contribution actually can vary from year to year, depending on the valuation results. And what happened is we calculated it, and the contribution rate for this next fiscal year is not changing. The PEPR member contribution rate is going to be 7% still, which is what it currently is, which happens to be the same as what it is for Classic members. So that's convenient for payroll people. And this last slide shows the projected employer contribution rate for the next 6 years following 2019-20. So starting in 20, there's a little typo in the first, that's 2020/21, what the employer rate is going up to. And you can see it going up for the next 4 years, up to 26.4. And the reason for that is when there is a change that increases it, we spread that increase over 5 years. So based on what's happened the last 2 years, we're projecting 4 more increases just based on what's already happened. So is there any questions?
Hi, Sean from LA County. I have a question about the investment returns because the investment returns were 8.6%, which is a full percentage over the discount, or more than a percent over the discount rate. I would have assumed that the funded status overall would have gone up, but it still continues to decline.
Right. So that's a good question.
Why is
So
that?
just over the last year, so every year, the first issue is every year the employer is contributing towards the unfunded liability. And we've increased those as slowly as we can. And if you were to look at the slide I took out to save time, you would see that the employer's contribution towards the UAL is actually less than the interest on the UAL. So if everything worked out perfect, we had no assumption change, no investment gain or loss, the UAL would be growing a little bit right now until those contributions ramp up to where they need to be. So that's one issue. The second issue was we changed assumptions in this last fiscal year, which increased the unfunded liability. Of course, doesn't change the assets, so that hurts the funded ratio, at the point in time when we do it, right? Going forward, you're much better off with those lower discount rate because it's going to be easier to meet the target, right? And then the other biggest issue that would affect the funded ratio from year to year is the one you mentioned, the investment return, which was positive, which helped, but it didn't offset those other two things. But that was a great question. Once these contribution rates ramp up to where they need to be, the contributions will be enough to start decreasing the unfunded liability. If we stop changing the discount rate every year, then you will see an increasing trend as long as the investment returns, are close to assumed. No more questions? Okay, thank you.
All right, thank you. Next, we have Tim Herbeck. All right, Tim.
Thank you. So they allotted me 20 minutes to do this presentation. I want to make sure I give Megan enough time to do all the system enhancements. I'm going to try to get this over in 5. And the way I'm going to be able to do that is Vina's going to answer the question for me on what is an out-of-class appointment, because she said she knows it so well, I don't even need to do this presentation anymore. You promised you were going to get up here and do this for me. Oh, only when I go on vacation. Now there comes the asterisks. All right, so does everybody know what an out-of-class appointment is? It's pretty self-explanatory. It's when somebody works out of class, right? We did have a new bill, AB 1487, went in, which clarified Government Code 20480, and that's specifically for the reporting of out-of-class total hours worked. And for this very specific topic, it has to meet very specific criteria, should make this whole presentation very easy. One, what is an out-of-class appointment? It's basically an appointment to a vacant position of a higher classification. Generally, we only see this for your higher-ups, right? They're not going to, if I leave, they're not going to be worried about who does my job because everybody can do my job. But if Brad were to leave, that's different, right? We need a Brad. We can't go without a Brad. Someone's got to fill Brad's shoes. So generally, it's for a higher classification, and it's only for a limited duration at a time. The best part is sometimes Brad may go on vacation, sometimes he may go on a leave of absence, and they would appoint someone below him into his classification until he comes back. That's very routine. It happens all the time. Leave of absence, military leave, maternity leave, paternity leave, whatever it may be. We're not caring about those total hours worked because it doesn't meet the definition of 20480, which basically states it has to be vacant for a limited duration due to a recruitment. The recruitment is going to be under my quotes because that's the most important part of this presentation. If the position is not vacant and being actively recruited for, we no longer move forward with this presentation because it doesn't fall under 20480. Now let's just assume that Brad left, unfortunately, tears on my eyes. We're recruiting his position, and we have Christina Rollins is now going to be hired into his position on a part-time basis. And because it takes us so long to recruit somebody to work at CalPERS, she has to work for an entire year. Now it goes over the 960-hour threshold, right? We're still actively recruiting. We just can't find somebody who wants to work for us. And she's filling Brad's position. So now if that case happens, anything that's over 960, when I say over 960, that equals 960.01 hours worked. You're going to be assessed a penalty of 3 times the employer contributions. This is probably the most difficult part of this entire government code to explain because a lot of times they ask me, what does that mean? What it is, it's the difference of member and employer rate contributions between the current classification for which I would work, Brad's position, or Christina's current position that she's assigned, and the compensation we would pay her for working in Brad's position, right? That contribution difference, if you apply the member-employer rate, that comes up with a total contribution amount, times divided 3, that's your penalty. Math was never my strong suit, but I can at least do times 3 pretty easily. The other easy part is employers will also be responsible for a $200 fee to cover administrative expenses, and that's just to keep me employed. All right, that all being said, we have done some great work in CalPERS to make this process extremely easy for you. We always take your feedback, we take your feelings into consideration, and we try to make CalPERS as great as possible. That's what Megan's going to get up here and tell you about later on. But for this purposes, last year we sent out a circular letter. We had this really informal document you had to fill out. Some of you sent us spreadsheets. Some of us just kind of wrote on a piece of paper and said, here are our people that we need to report. Well, we're no longer going to accept that form. We're no longer having you do it manually. We no longer want Excel spreadsheets or Word documents or PDFs. Everything's going to be done in CalPERS. So the system's going to allow you to certify the hours. It's going to allow you to submit records for employees. Even better, we're going to allow you to upload your labor agreements and salary schedules directly into CalPERS so we can confirm the compensation. You'll be able to actually view the penalties. So my little thing about 3 times and not figuring out what the 3 times is, we actually will show you what it is before the receivable even gets created. And then we're going to give you about 8 months to figure out if that receivable is correct before we generate the actual receivable from our financial office for you to pay, if you have anybody to report. So what does it look like? CalPERS, I love screenshots, right? So many of you probably today have already seen this page. If you select your reporting tab next to the pay schedules and you go into the out-of-class validations, it's going to ask you for a very first question. Ignore the second and third sections for right now. The biggest part is, do you have an out-of-class appointment to report? And talking to most of you, you guys say, yes, I have one, so you're going to check yes. If you have nobody, we still ask that you come onto this page and just say no. That's as easy as it is. No, call it a day. If you have somebody, it's going to go, okay, now it's very similar to our payroll reporting process where you can search or you can add a new person. And similar to that, if you were to enter their social security number or CalPERS ID, select add new, you come to another page. We're still making it very easy for you because we're going to ask you a couple more qualifying questions. Those questions are, is this a vacant position? You're like, yes, it's vacant, Tim. The person's on leave. Are you recruiting for it? No, we're not. You're going to get an error message to say, thank you for playing. Stop here. Go back. You no longer have to continue. If you only answer yes to both, and it has to be specific, yes to both, vacant and actively recruiting, will you be required to move forward? And so here, very similar to like payroll reporting, you enter the begin date of the period and the end date of the period. Say, you enter the appointment. They may have one or more appointments. And we have two sections. Christina Rollins is an SSM2, so we're going to put SSM2 as her position. What is her monthly pay rate? What are the earnings that she reported? And that's it. Now she's going to an SSM3 position, Brad's position, right? So he's an SSM2. In this example, I have District Instructional Materials Technician. That's a very long position title. And then what is your monthly pay rate and earnings? For us, we didn't do a personal action form. She's still technically in our HR system as an SSM2. So her pay rate and her total earnings aren't going to change. The only thing that would change is maybe we pay her temporary upgrade pay for that difference. You know, she's not going to work in a 3 position for free. She wants a little bonus, right? So that bonus generally is temporary upgrade pay. Some of you may have that in your MOUs, some of you may not. Some of you may actually do the personal action form to change your classification. In that case, then we would see a different pay rate and a different earnings amount. And you would have a 0 value under total temporary upgrade pay reported. Then you enter the total hours worked. So in this case, it's 990 hours. You select the lovely calculate button, and then it automatically tells you what the penalty is. And if you can, well, you can't see, but if you were to look at your printouts, underneath each section will have the member and employer contribution amounts associated to that compensation. If you were to combine those times 3, that would equal that penalty. So now we have to verify if it's 960 plus. We want to verify, is the pay rate in the position correct? Do you have qualifying MOU language that allows you to report temporary upgrade pay? So the best way we have you do that, and this is another great feature I love, is we allow you to associate documents. In my CalPERS today, you can actually do this. And you don't only have to do it for temporary upgrade pay, reporting out of class hours worked, but you can also do it just to help our comp review unit out. Is you can upload your salary schedules and your MOUs. And instead of us going to the website or calling you saying, hey, can you give us that 1994 MOU? You know what? You can upload as many as you want. Name it, give us the effective date, and we'll have it in our library. So once you have your library built, you should see documents that are already there. If you go to this page today, you probably already see some of your MOUs and labor agreements and salary schedules in our system because you've been working with our compensation review unit over the last couple of years. So we have already uploaded some of them, but they may not be named correctly. So we also give you the ability to update them. You can inactivate them, or you can upload a new document. Let's just assume it's perfect. We have all our documents. All you're going to do is select the checkboxes, hit the associate to appointment button, and return. And it'll actually associate to the document, to the record. If you can't find it, basically this is the same process. You can just go ahead and upload it. You can give any document name you want. It has to be effective based on your board-approved effective date. And then what position title or group does it represent? Does it represent your classified management? Is it your certificated? Is it your confidential employees? So you can name it. Then once you select them, we're going to have you go ahead and just associate it. You select it and associate it, and it'll take you back to the original screen. So, timeline. When does this all begin? By the end of May, hopefully early June, we plan on sending you a circular letter. I drafted it, so it's a brilliant circular letter. It includes a lot of hyperlinks that include the training materials, so we're not going to only leave you out there in the cold. I'm going to show you and train you how to do it. We're going to give you a FAQ, or frequently asked questions, document. And by the way, thank you to those of you who have already asked me, Vina, a bunch of questions, because I included most of your questions in my FAQ. As well as we're going to give you a computer-based training module as well. So there's a lot of training materials that are going to be attached to the circular letter and drive you to the website. Then we're going to send out 2 annual notices. Towards the end of June, we're going to say, hey, July is coming, get ready to report. And then if you're non-compliant, we're going to do it in August to say, hey, you're non-compliant, you need a report. That's the annual notice and failure to comply notice. What's important to know here is most of you guys are county offices of education, right? I have probably a few districts. So this is the problem, or the, not a problem, this is the roadblock, generally I like to say, is that you hear this great message I'm giving, but your districts don't. And so the problem is that you don't have the personal action forms to say whether or not this is out of class. Your districts do. So unless you guys go back to your office and say, hey, watch Tim's great presentation, your districts are not going to know this, right? So we are really counting on you as a county office to disseminate this information down. The June letter is going to go to every county office in every district, and districts will be able to report out-of-class hours worked. If they report them, they're going to get the invoice for any kind of penalties. If you report them and you have a district who doesn't report, we will never know. So since they have all the information, all the data, you may want to guide them to do this themselves. If you want to control it all, you can. I know some of you like to have your arms wrapped around your lovely districts a little tighter than others. Just know that June, we're going to allow everybody to do it. And then August, if you or none of your districts do it, so it's you plus 0 districts, we'll send you a failure to comply. That failure to comply letter only goes to the county offices. So that's the notifications. Now that I'm done and I've kind of wooed you all, I'm assuming there will be 0 questions. Oh, of course.
Not nice, not nice. Ramona Coker, Stanislaus County Office of Ed. The first screen where you go in and you select, yes, you did or did not have any out-of-class employees, districts are going to have access to that portion?
Mm-hmm.
Do they have to have payroll access to get to that access?
That is a very great question. I knew you were going to ask it because I came prepared. So Ramona basically wants is what kind of access? Now, I've been doing system stuff for a lot of years, right? Many of you know me back to 11 years. I would not create a page that gives minimal access to only one person, especially since I know none of you like to give payroll access to your districts. So how I created this page is anybody who has the maintain system permission sets, the human resource permission set, the retired enrollment permission set, the payroll read only, they will all have access to this, especially human resources because primarily they're the ones that track your personal action forms. And if a district reports it, like I said, they're going to get the receivables and invoices.
Tack on question then.
Uh-huh.
So they are going to get the invoice, but they do not have access to the payment area.
Well, they
I
should.
actually get that they do not have access to the payments, billing and payments. So would the county office also see that in there?
No. So there's a lot of fees that are not specific to payroll reporting. And I want to make it very clear, out-of-class validation of total hours worked is not a payroll component. It is an administrative cost, and a cost that has not occurred on any member. It's occurred on the employer. So if your districts report it, just like any other membership or GASB 68 receivable or any other admin fee or receivable that CalPERS could generate at a district level that is not associated with payroll reporting, they should have access to make a payment. If you have not granted them access or given them a system access administrator and you're going to require them to do out-of-class reporting, I recommend you give them access to make payments. And they will only see the receivables that are generated there to pay those. Otherwise, they're going to have to send you the invoice, you're going to have to send them money, and they're going to have to pay it through my CalPERS. Or you just don't have them report.
So I think this is the same issue that we had with the retiree fees in the beginning, where the districts were receiving those fees. They were invoiced, they couldn't pay them. Only we could pay them. So there was something that was fixed so that now the county office is getting those and can pay them.
They may send it to the contract holder because payroll is for contract holder. The tracking the total hours worked is not a compensation or payroll component. It's like a GASB 68 or actuarial evaluation or any other administrative fee. So if you want them to pay it.
We get the GASB,
Okay.
we get that GASB invoice.
So no, if you want them to pay it, give them access to it.
Okay, I don't want to pay it.
Hi, Tim. Teresa Cooney, Los Rios Community College District.
Hey, Teresa.
So on that page, when it's asking, the 2 questions, do we have to report everybody and answer those 2 questions for everybody who has an out-of-class, or only if we know the answers are going to be yes and yes, do we have to go in there and put those out-of-classes in there?
Yes, yes. Not everybody knows because you guys are the only ones that are getting this communication out, right? Public agencies aren't, and this also impacts public agencies. So the circular letter go out, so they may not catch on to the actively recruited part. And so if we have to give them a yes, no concept. But if you know that they're leave of absence, then no, you don't even have to track them, you don't even have to report them.
Great, thank you.
For the payment portion of this, since it's not employer contributions, the district can pay it by warrant, right? It doesn't have to be an EFT payment. It's not mandated by that law.
That's a John Hensley question. I don't know. I mean, it's a receivable that's generated, so I don't know if the EFT mandate is associated to admin fees. Good thing John's here.
Good morning. It won't be legally or by statute that you have to pay by EFT. We encourage paying by EFT as opposed to check. So our preferred method is EFT.
Thank you, John. I know.
Hi. So you said everybody who has access, like HR, payroll, read-only, so the letters are going to go specific to which contact? What type of contact?
The letter itself, I believe, is going to be sent to the general primary contact's preferred method of communication through my CalPERS. If we don't have a primary contact, then it may go to the address at the employer page level that you define in the employer's preferred method of communication, because you can have both. Otherwise, it's just going to be a mailed out form.
But the penalty is only if they exceed the 960 hours, correct?
That is correct. And there's a little stipulation to that thing too, because I really don't like penalizing you, is that it has to be on contributions not otherwise reported to CalPERS. So you'll see a penalty, and what happens is that we're going to get a workflow, and we're going to probably contact you to say, is this out of class? Were you recruiting for it? Or was the person on leave for 5 months, and then the person was working out of class, and then you began recruiting for it, but you're tracking hours while the person was on leave plus the recruitment period. And so we'll adjust the hours. If it's a true penalty and you reported temporary upgrade pay to us, contributions were paid against that temporary upgrade pay, so we will back that out of the penalty, because the penalty is only on compensation that doesn't have contributions otherwise reported to the system. Debbie gets the last question. Sean goes first.
Just a quick clarification that let's say person A left and you filled in, you did 960 hours, but then person B left, so you do another 960 hours, so you can have multiple positions in a fiscal year.
Yes.
I'm just verifying.
That is 100% correct. Great question. It's part of our FAQs, by the way. A lot of the questions is what happens if, say for instance, I'm so good at what I do that when Brad leaves, I work 960 hours. And then they fill his position. And then all of a sudden, Jennifer, who is our other SSN3, leaves. And they like, Tim, we need you here too. So you work in that position. I work another, say, 960 hours, which technically, I guess, 2080, yeah, it could happen. The penalty is only per position. So it's per appointment. It's not combined both. So I can technically work 950 in one and 950 in the other, and you will not have a penalty. But you do have to add each one to the system.
Suppose you've tried your hardest to recruit for the position, and you can't fill that position, and maybe you have a retiree or someone who's potentially going to retire who's filling in, and they don't want the upgraded position because they're planning on retiring, and you exceed those 960 hours. Is there a way to waive this fee, or no?
No.
You're just going to charge us?
That is the intent of the bill, is basically to prevent employers from having somebody rotate through and never actually assign somebody into that permanent position.
Even if you're actively recruiting and you can't find someone?
Yes, Because, I mean, I can put a bulletin on the website, say I'm actively recruiting and have no intention to recruit. So if you have one person who's an active member working in that position and you're actively recruiting for it, it's out of class, and they exceed 960, you're going to pay the penalty. Sean.
Tim, I just wanted to follow up the last part when you talked about the penalty being on the difference of contributions that would otherwise be received, or I forget the exact wording you used. Is the new circular letter going to go into those details? Because I know Brad talked about it a couple meetings ago, but I'm really hoping that the circular letter will outline some of the specifics of the law, how that penalty is assessed, because I know it gets a little bit tricky. So I was just curious if your new circular will address that, in addition to all the instructions and how you actually go about doing this process.
So again, like I said, I drafted a circular letter, so it's really good and really great. It should clearly define it because we have a section specific to the penalty calculation. If it doesn't do it, then we also have a question which is, when is the out-of-class penalty assessed and how do we make payments? And how do you assess the penalty? So I'm hoping that our FAQ document will clearly define it. And that's why also we made a change, because originally between the active and the out-of-class position on this page here, and I know I'm getting close to my time. On this page here, it used to say total earnings and total special compensation for active, and then total earnings and total special compensation for out of class, because the penalty is only on compensation that's defined by a salary schedule. It removes all components of special compensation, so it's only on just total earnings, because that's what the government code calls out, is just a salary schedule. And in order for us to know whether or not we have to back out the penalty on contributions paid to the system, the only time you would pay contributions to the system for out of class is if you have temporary upgrade pay. So if you do a position, personal action form to change pay rate and earnings change, and there's no temporary upgrade pay, you paid contributions on it already, the difference. So there's going to be no penalty, and we'll be able to do that. So hopefully, I can send you my draft, and you can tell me whether or not I'm there, Sean, but you know, there's always improvement. I'm not going to say I'm perfect, but I'm pretty close.
Well, because Brad... No, I appreciate it, because Brad talked about it a couple meetings ago, and I subsequently, I couldn't publish anything out to all of our school districts, but I sent the link out of this meeting to just a select number of people so they could see that, you know, there are concerns on some of those fees in terms of how you go about compensating employees can be alleviated. If you're actually doing a personnel action form and you're putting them on the pay rate, then that penalty goes to zero.
Just because it's you, Sean, I'll give you a pre-view of my FAQ, and you can tell me if I missed it.
Sure.
All right.
Great.
I just want to add real quick, it is a really good circular letter, and there's a link on the circular letter to the FAQs. And since the FAQs aren't completed yet, maybe, Tim, we could put a really good example in the FAQ before we publish it.
Okay, yeah.
Because I think that's a good call to make sure that everyone understands that. Because I really don't think there's going to be tons of fees assessed on this because of that very rule. Right, if you have a classic member, more than likely they're going to get temporary upgrade pay, or they're going to be put into that position. Even for PEPRA members, you could put them into that position. It's really going to mostly be assessed for PEPRA people that aren't eligible to get the temporary upgrade pay, and you weren't able to move them into that position. But I think that's a good idea in the FAQ. We could spell that out a little more clearly.
Am I done?
Yep.
Okay.
That's it. All right, system enhancements.
Megan.
Megan.
Good morning. My name is Megan Cordy, and I am the manager over the System Support Unit at CalPERS. So today we're going to be talking about 4 current and future enhancements. We're going over a new health enrollment process. We've added some fields for non-binary. We have 2 updates for the retirement appointment reconciliation, and then I have a brief update on payroll reporting. So first, we'll go into the health enrollment process. This will be in the June release, which is June 15th. What we have done at CalPERS is we've actually removed quite a few of redundant screens. So your whole process flow for health enrollment should be significantly shorter and more streamlined. We've added on-page return links within the flow of doing any health enrollment process. This allows for you to page back to the previous page so you don't have to start all over if there is an error or a mistake. We've also allowed for you to update dependent demographics within that same process flow so you don't have to process multiple transactions if you're doing any other kind of update or change. And then we have a new confirmation module at the end of the health enrollment process, which allows you for multiple options, including printing a confirmation page so you can keep that for your records. You don't have to go back into the system to view and see what was done. And then because this is such a significant change, we're updating our student guides, and those will be released in mid-June as well. And then for non-binary, the state of California adopted Senate Bill 179 in 2017, which went into effect January 1st this year. And this basically says that non-binary is now an accepted gender. So we updated my CalPERS within all of our gender dropdowns to allow for non-binary. So now we have 4 options: male, female, non-binary, and unknown. If you are a file reporter, we are also accepting that as well, and we will be updating the schemas and the documents and sending that out to you. Again, this is in the June release. Right now, only the notifications that are being sent from my CalPERS will have the correct pronouns for this gender. If we have a form that is something that one of the members needs to fill in, those have not all been updated so that you can accept a write-in for non-binary if they so choose, but the option within my CalPERS is available for you to select. And then I have 2 updates for the retirement appointment reconciliation. On Sunday, we actually made some updates that are specific to school employers that have more than one active payroll schedule. So what was happening is that enrollments were being flagged twice on both payroll schedules. Now, for any new enrollment or where no payroll has been reported, you will see that member reported on the most frequent schedule. But once payroll has been reported, then it's going to be the last reported schedule that will be identified. So this was going to remove any duplicates. And then for anybody that has a dual payroll data owner, we also removed any duplicates on page as well. So you'll only see 1 member, not 2. Or 1 line item per member, not 2. Okay, and then for the June release, the school office and school district staff will be able to confirm unposted payroll for up to 1,000 employee appointments at one time on the RAR page, or excuse me, reconciliation page. So we are trying to synchronize both the payroll schedules page and the reconciliation page. So if there is a pay period that you want to confirm no payroll for entirely, you'd be able to do that. And we've added some additional filters as well. And then we are also adding in some on-page links in the, there's 2 additional screens, which will allow for a pop-up, so you'll be able to see more information for the member without having to navigate away from whatever process that you're doing. And then this is the last one I have for you today. And Brad's going to give a little bit more information on this, so I'll just touch lightly. But starting June 15th, you will now be able to report a $0 payroll line to CalPERS. And you can do this both on my CalPERS and if you are a file reporter or an XML file uploader. And this is going to be great, so you can do this in lieu of confirming missing payroll. You'll be able to just let us know in advance that there will be a $0 payroll for that member for that period of time. And then all of our resources do get updated periodically, especially the health enrollment resource, the student guide for that. Again, that will be updated mid-June for this release. Does anybody have any questions that I can answer with the exception of the zero payroll? That was your question. I thought ahead.
Hi, I'm
Hi.
Erica with Riverside County. I
Hi.
have a few questions about the reconciliation screen.
Mm-hmm.
The first one is regarding the exporting to Excel. We've noticed that if we've done like a filter and then we try to export, it doesn't export specifically what's on the screen. It'll export everything onto one Excel spreadsheet. Is
Okay.
there going to be a fix for that?
Is this on the main page, correct?
Yes, so if you're in the main reconciliation page and then you search by certain filters, when you export, it doesn't export only what's been filtered, it will show everything.
Okay, so we will take that back and research it and work with our IT to see if we can get that resolved. So thank you for bringing that to our attention.
Thank you.
The other thing, the biggest complaint, I guess I'm gonna voice a complaint from the districts.
That's fine.
Anytime that they filter and then are confirming, anytime they confirm one person, when it goes back to the main screen, it resets the filter, so they have to filter all over again, and I know that's very time consuming.
Okay.
I thought that was
They basically have
being,
to filter after each person they confirm.
I thought that was being resolved in our latest release, but we'll confirm that because we did hear that complaint
Okay.
prior.
I tried it yesterday and I think it was still doing the same
It's still doing
thing.
it, okay, so
Okay,
we'll
we'll look.
look
I know
in
you
and
guys just
get back.
recently made some fixes.
Yes.
And then I wanted to ask regarding the past due date. So when exactly does the reconciliation screen recognize that something's past due? Because say for like our monthly report, our due date is April 30th. So I'm thinking that it becomes past due May 1st. And I've noticed that when we filter by the past due yes, some items don't appear at all, but then when we export to Excel, there's stuff on the Excel
So even
that's
after
not-
your due date, they're not appearing.
Right,
when
so
you
I don't know
submit.
if there's like a discrepancy in regards to like when it becomes past due or when the system recognizes it as past due.
It should recognize that at midnight, the day that it is past due. So if it's not doing that, that's something that we can look into also, because it should be doing that.
Okay, and my last question, I promise.
No, you're
Do we have a date for when the invoices will be generated? The
The-
retirement, is it projected contribution invoices?
I don't actually know that. John Hensley probably will have that answer, because we're a little separate. Yeah.
Okay, thank you.
Okay, it is now time for break. So why don't we come back at 10 minutes till?